Welcome back, traders. We're going to be watching another ICT lecture today. Now, he's been doing the Storyteller series, but personally, I don't see much difference between that and the 2025 lecture series. He went back to that name for this video, but I feel like they're pretty much the same. Now, this one is going to be on EurUsd and NASDAQ futures. So you're getting a 2-for-1 combo today. Let's go ahead and get started. And of course, the original video is in the description.
This is the NASDAQ. This is a daily chart. And if you recall, check your notes. If you've been following along on X and all the analysis and commentary I've been giving guidance for this specific index, NASDAQ, I mentioned that we were looking for higher prices. We're continuously looking for higher prices and ignoring the natural tendency to want to pick a top. If top comes, we'll know it. But right now, it just keeps on trying to reach higher. And I want to show you, again, when price was down here, we were looking at the likelihood of drawing up into this imbalance, this wicks consequent encroachment, and then this SIBI here, ultimately drawing up to this high and then all-time highs. Okay, so those are the levels that are salient to me that I mentioned, and I'm not just mentioning it for the first time here, but it's been drug out over top of about 2 months worth of data.
So all the way back on April 20th, I believe, is when I first mentioned the market going to make new all-time highs. I think every market outlook after that, I kept mentioning new all-time highs, until 2 months later, the prophecy came true. During this time, I was not keeping up with the ICT lectures, so all those market outlooks was purely my own analysis without any influence from ICT's analysis. Now, I make sure not to watch these lectures ahead of time before I'm ready to record and upload. I'm still catching up. As you can see, this video is from June 11th. So here we haven't reached all-time highs yet.
This wick, this consequent encroachment of that half of that wick is what's being highlighted here. Now, if you look real close, it looks like it gets blurry. It's because there's another level there. We'll see it in a moment. But I just want you to see that there's a confluence of that occurring. So just before I drop down, I want to make sure that this is going to show up on all time frames. And it looks like we're good to go on that. Okay. All right. So today we have CPI number and tomorrow we have PPI and all kinds of stuff going on around the world. So it's a Molotov cocktail, basically. You should not be trying to trade aggressively, as I mentioned on X. I just want to toss it in there right now. And just know that we're in the summer months with all kinds of volatile events around us, both domestically here in the States, which, as a kind of like a reminder and like a all points bulletin. If you are in the States, be careful this weekend. Okay, there's a lot of things that some nefarious individuals and entities are scheduling to run amok this weekend. So it looks like rain, so bring your umbrella. We have this buy and balance on efficiency here on June 3rd, 2025. And then the market has reached up, used this down close candle's opening price, which is changes the delivery, my order block. And you can see that there. And then we drew up into this wick, as I said we would do weeks and almost a month ago. Wicked so far, but look at all the overlapping of these candlesticks in the previous day's ranges. So this is a lot of time being spent in here. So my perspective is this, in brief. Retail's trying to short this, and they just keep pressing it higher. Okay, CPI and PPI number may deliver us into this fair value gap here, and I would be content with that if it was something that I was in the market. If I was in there actively holding a position, I don't have an open position right now, but I would be looking for it to trade up in here. And if it did, I'd be content with moving to the sidelines and just relaxing. Okay, trying not to press too hard because the climate we're in right now is not conducive for low risk, but rather high probability of you being incorrect. Okay, so professionals don't like to push the edge in those kinds of environments because the only thing it does is it dulls your edge needlessly. And this wick down here is consequent encouragement, so it dropped down in there, opened there, and then rallied up. So we're going to take this information, drop all the way down into a 1-minute chart because it's already getting too long in the tooth here. So there's your February 24, 2025 daily SIBI. Okay, this candlestick's low to this candlestick's high. The fib levels in here, watch these lines in here. See, there's one there, and then this one here is anchored to that. If I go to the fib and highlight the negative 0.5 level, that will take us right up into consequent correction of that wick. Okay, so essentially, what is that, 981 even or thereabouts? So we'll see it when we down lower time frames. So now we have the quadrant levels in here, and that expansion boundary where it can trade outside of that range of that CIVI. It's basically the same principle I taught with -1 and -0.5 for the opening range gaps. Okay, so that principle is universal. So it's half of and or a replication of a range. Those are usually the easiest go-to demarkers for when we're in a consolidation or a defined range of any kind. Half of that range or one standard deviation or full, basically a measured move type measurement of whatever that range high and low is, whatever it is. It's usually going to move outside of it by half of its range or one full measurement of its high to low range. And again, if you watch any work on my opening range ideas, you'll know what I'm talking about. So let's drop down now into the 1 minute chart.
Okay, so if you guys missed that part, rewind and listen to it again. It's kind of hard to grasp what he's saying there, and I'm not sure if I fully understand it also, but what I think he was saying is any range that you would normally grade, you can project 50% or 100% of the range outside, and that's where price could trade to outside of the range. Like this daily CIVI here, we expect price to trade to it, but how far outside can we expect it to trade to? And I also think this works in the other direction. So if you look over here and you project 100% of this fair value gaps range down, it looks like you're going to get very close to 50% of this wick, which is also how far we retrace to before rallying back up. Now, this technique is something I'll keep in the back of my mind, but I don't think it's something I'll use as a main tool day to day in my analysis.
This is what I have here. And see, by being organized with your annotations, it'll tell you when you're in the lower time frames what this is. All right, and then the lower quadrant on that February 24, 2025. So we have the low of that daily CIVI on the 24th of February. Notice we have not traded down there. We got down to the lowest quadrant here, and then we traded down into that order block. Remember, look at the daily chart and you'll see what that level was right there, okay? Trade up to the high of the 24th of February's CIVI, and then back down to that order block, traded just outside of that range, that daily CIVI, then back down into the upper quadrant, then up to that negative 0.5 level, which is also the consequent encroachment of that premium wick, and it's also negative 0.5 of the daily CIVI on February 24th, 2025. Now, for someone new that already has your head spinning, you have no idea what I'm talking about, but I promise you, if you watch the video a few times, because right now it's only been a couple minutes, like 8 minutes or so, you'll see what I'm talking about, how these levels are converging. And it also takes out this little high here. So notice that we've basically just used the levels I told you to watch on the weekend, before the weekend started trading, and just reacted off of these quadrant levels rather nicely, consolidated around it. Judas swing, pumped it up, dropped down. Order block, lowest quadrant of the February 2024. I'm saying 2024. I thought I said that. Now I'm certain I messed up earlier. February 24th of 2025's daily CIVI. That's what these levels are marking. This is the consequent encroachment, midpoint of it, upper quadrant, and the high of it. So we reached up into a convergence of consequent encroachment levels, okay, clustering there. And now we're using the high this morning in London of the daily CIVI on February 24th of 2025. Rallied up. And I want to drop into where we're at right now. And to me, these lows are suspect. So they can come back down in here on the CPI number. Because sometimes CPI can be a one-way railroad, just runs right over top of you in one direction. Sometimes it can be a two-stage delivery where it could drop down, take the liquidity here. And since I'm primarily bullish, I'm risk on and weak on dollar, so I don't think the dollar's going to go higher. There's no reason for the dollar to go higher. So many things against it right now, and I believe gold's going to go higher. And if you take a look at silver, I mentioned last year in the fall months and summer, told you all to start really adding on to metals. And while silver was being consolidated and held, it's recently been allowed to trade higher. I don't think that's done. I think all the data centers that they're trying to build, all those things like that are going to require a lot of silver. So I think that is a fundamental driver if you want to go there. When it comes to commodities, then I believe there is a supply and demand factor. Otherwise, everything else outside of that asset class is all BS. There's no real reason to own a share of stock. There's no real reason to own, a contract of NASDAQ index futures. There's no real reason to do that except for gambling is really what it is, speculation. But with commodities, there's a real net sum zero game to it with regards to supply and demand.
So I don't have much to add right here, but I do want to mention that ICT did a few videos about commodities in his core content playlist. Month 10 has 5 videos about commodities, and even if you don't trade commodities directly, commodities along with bonds, currencies, and the stock market are all correlated with one another. So it could be an interesting study on a higher level. If you want to check out ICT's intermarket analysis video in his core content, I believe it is month 5, episode 9.
But I think we could drop down into here at the very minimum, drop below here, and then maybe move higher. But just be mindful that CPI number and PPI numbers are absolutely unknown to me. I've not had confidence in being able to forecast the PPI and CPI number in my 3 decades plus. Once in a while, in a blue moon, I've been correct, but not to the degree where I would place a lot of risk behind that trader or viewpoint. So just know that what I'm saying here, just study it, okay? Just watch and see if there's anything to it. So that's the skinny on that. I want to take your attention to Euro because I did talk about that also over the weekend. But inside that area, I was counseling you to look at just ignoring this candlestick is indecisive and using this candlestick's low, this candlestick's high. That is your actual gap. Extend it through, and trading through here, it looks sloppy. It's like, okay, what's the use here? Well, I mentioned that if we didn't get this expectation of moving higher, in other words, I wanted to see it remain above this. But if it does go below it, go back and listen to the video. If it does go below it, then I think what we'll do is we'll go into sideways consolidation. And I think by anybody's definition, that's what you could see here. Okay, so those skill sets, those ideas are not found in books. That's an experience-driven perspective. And the things I teach you to do and things I tell you to keep track of and annotate and journal, if you don't journal, you'll never learn the skill set of anticipating when consolidation is going to be there. If you look at the very first video of my 2016 private mentorship, all of those videos are uploaded on my YouTube channel for free. Just look at the ICT mentorship 2016, 2017 playlist, and I broke them down into individual playlists by month. And the very first video of month 1, Elements to a Trade Setup, I talk about the 4 major characteristics of a trade setup. There's an element of consolidation, and you're not going to know in the beginning how to anticipate when consolidation is going to come into the marketplace, and you're not going to know as a new trader when that market will leave consolidation and go into a trending or a reversal or something to that effect. And that's one of the benefits of having a mentor that's been doing it for a long time and not just talk about it through a market replay perspective. If you don't have the foresight or the experience to be able to have prognostication that has a track record of a length of time beyond just last year or 2 years, parroting somebody else that's been doing it decades longer than them, it's very telling when you listen to someone when they share insights, because if they can't, number one, stand on transparency and say, there are times I'm not going to know. And right now, I don't know. I just know that if we did not use the inversion fair value gap to go higher, then we were going to go in consolidation, because everything is still primarily risk on, meaning all assets that are not dollar viewed, in other words, euro dollar, euro is higher, dollar lower, or dollar consolidation, euro higher. That's risk on for me. Risk off would be dollar index rallying higher, euro going lower, or euro in consolidation while dollar goes higher. That's risk off. So I'm primarily anticipating higher prices across the board, except for dollar.
So the 2016-2017 playlist he mentioned is the same one from before when we were talking commodities, the core content playlist. Month 1, episode 1, he talked about the 4 phases the market will go through: consolidation, expansion, retracement, reversal. Now, the core content is very good in my opinion. However, it's very broad, covering a plethora of market concepts, most of which, honestly, you don't need as a new trader. In fact, it may slow you down because when you try to learn many concepts at the same time, it'll take you longer to master each one versus when you only focus on 1 or 2. and some of the core content videos are over 2 hours long. So check out these videos if you have time and if you already have a good grasp of the basics. But if you're a beginner, I personally would recommend focusing on the concepts taught in the 2022 mentorship. And if you watch Tanya Trades, I believe she also says that the 2022 playlist is her favorite.
For someone that's new, you might see this, and you may have watched Euro this week and probably giggled to yourself and said, this guy, he was really wrong on Euro. Well, I explained why I would be wrong, and that's something also that's useful as a trader, knowing what would be a catalyst for you to move to the sidelines and say, okay, I'm not going to trade in this environment because it no longer fits the characteristics that I would expect initially, and still be useful for the model I trade and not be gambling. Okay. Just because the markets are moving around doesn't mean that, hey, let me go here and press the button and see if I can make some money, or I'll pass some combines or this, that, and nothing. Messing around, mucking about in these environments, you will blow your accounts. That's a guarantee. I don't care who you are. I don't care how good you think you are. You're going to blow your accounts because you're going to get tripped up into taking more trades than you should. You're going to trade a larger leverage than you really should. And you're going to be competing with everybody else online because they may have done something and you've not been able to show anything yet, or you're in drawdown. So this present condition in the marketplace right now, with all the things that are going on, this is a perfect storm for someone that has no discipline, no self-control, no model, no experience, no respect for the measure of risk. It's a shipwreck waiting to happen. And nobody's at fault but you when it does. So anyway, with all that, I expect higher prices. With the same thing I mentioned with in regards to NASDAQ, let's say that the PPI and the CPI number do something that causes some kind of a sell-off in gold or Euro. I said gold, but I meant Euro here. These lows in here, I'd like to see them make an attempt to get down there, but not take them out because it's too close to this low here. So if it's going to take these lows out, then it's going to take that low out. And that changes the dynamic, at least on the short term. Doesn't mean that I'm calling a top in the Euro. Doesn't mean that the dollar's going to go rallying higher explosively. I'm not suggesting that at all. That's my opinion. But none of this should be used as a trade idea or a catalyst for you to put on real monetary risk. It's just to stimulate ideas and thinking critically on your own part. But I find it fascinating that today we used that inversion fair value gap I mentioned over the weekend here. And I'd like to see it draw up in this level here and then this for Euro. Watch this. I would like to see this in here act as an inversion fair value gap sometime before we close this week out. That would be interesting to see that. And then should it do that, then obviously make an attempt to get up to the buy side here.
All right, so at the end, pretty much a warning on the dangers of trading and consolidation. The video was lagging a bit with the audio, but he's talking about this high there at the end. Now, one key takeaway I have was earlier in the video where he talked about projecting the range of a fair value gap to anticipate where we can expect price to trade to outside of the range. But anyways, that will do it for this one. There's only a few more lectures left before I'm all caught up, and ICT looks to be taking a break at the moment from putting up more lectures. So I'm thinking, what should I study once I'm all caught up? From most of the comments I've seen, it sounds like you guys want to see the 2024 lectures. After this lecture today, it really made me interested again in the core content videos. I wonder if you guys are interested in that as well, so please let me know in the comments what you think. Also give this video a like and subscribe for more, and until I see you next time, safe trading.